So these are our federal tax rates. We're going to just stick with federal tax here. I'm not going to add provincial tax in because it somewhat confuses the situation, especially when we talk about taxation of investment income in a few minutes. So we'll leave the federal tax like so. So we know now that our taxpayer has an income of $60,000. Well, we take that first $40,000 and we apply that rate of 15%. And then we take the next $20,000. Keep in mind that would have been $30,000 if not for those deductions. We take that $20,000 and that's going to be taxed at a rate of 22%. So this person would have $6,000 of tax to pay based on 15% of $40,000 plus another $4,400. This person has a total of $10,400 of federal tax that they're going to have to pay. Now, before we go on to talk about that amount of tax that they're going to have to pay, there's one other thing that we should talk about for a minute, and that is the savings that this person generated for their deductions. I've mentioned it a few times now, but this RRSP contribution and this requirement to service this interest resulted in $10,000 less that was taxed. So really, we could say that this person saved $10,000 times 22% from their tax bill. They saved themselves $2,200. An exam question you might run into is we have a taxpayer at a 22% tax rate who makes a $5,000 interest payment. The loan is used for a non-registered investment with an expectation of profit. What is that taxpayer's savings? Well, this taxpayer has saved $5,000 times 22%, or $1,100 in tax savings by virtue of their borrowing to invest, their leveraged investment here. So we're floating along nicely. We're not quite done. There's another system that that Revenue Canada has put in place, Canada Revenue Agency has put in place to help us save a few tax dollars. The system is called tax credits. And we all have tax credits. It's much easier to get a tax credit than it is to get a tax deduction. There are a number of tax credits out there. Some of the more common ones include the basic personal amount, which is about $10,000. We have, if you have children who play sports, for example, you can take up to a $500 tax credit per child playing sports if you spend that much on their sporting activities. Let's use that one. Let's say this taxpayer has 2 kids. We get tax credits for our contributions to Canada Pension Plan and Employment Insurance. So EI and CPP both provide tax credits for us. When we pay into them, let's say that this taxpayer has paid $3,000 into Canada Pension Plan and Employment Insurance. So this person ends up with $10,000 plus $1,000 plus $3,000, $14,000 in tax credits. Okay, that's great. What do we do with that? Well, tax credits are always given at the lowest marginal tax rate. Except for tax credits related to charitable contributions, which can generate a tax credit of up to 50% depending on your province. Tax credits related to contributions to a federal political party are very complicated and tend not to yield a 15% tax credit. And the dividend tax credit that we'll talk about in a few minutes also does not yield a 15% tax credit. But most tax credits that most taxpayers deal with generate a 15% credit. So this person has $14,000 in tax credits. They have the basic personal amount, which all Canadians have. which is roughly $10,000. They have a couple kids who play, let's say, hockey, and they spend more than $500 per child on hockey, and they themselves have contributed to EI and CPP. So they would end up with $14,000 times 15%. 15% of $14,000 is $1,800. So this person now has $1,800 in tax credits. What we would do with that is we would actually reduce that right off of the taxes owing. So we take $10,400 minus $1,800. That gives us $8,600 as this person's final tax bill. So then what happens, we go through this whole process, and this is actually what your tax return does. Your tax return gets more than one whiteboard to do it, which is why it's a little bit cleaner. But your tax return ends up at this amount when you fill out the T1 General at year end, or when your accountant or software package or bookkeeper or whatever you happen to have does it for you. So what we would do then is we say, okay, throughout the year now, I earned a paycheck, I got a paycheck, and my employer withheld something off of every paycheck through source deductions. So that withholding amount then is supposed to be roughly equivalent to what you end up owing at year end. If your employer withheld more than what they were supposed to, that is, if this person's employer withheld more than $8,600, then this person is going to get a refund back. Then we say, okay, that employer took more than what they should have taken. We're going to end up refunding you the difference between the $8,600 and what your employer took. If the employer took exactly $8,600, there will be neither a refund nor an amount owing. If the employer took less than $8,600, that is, underestimated the taxes payable, then this person ends up writing a check. So this really explains the basics of personal income tax. We're going to move on from this point, and we're going to discuss the taxation of investment income. Like I said, you do not have to memorize these figures for exam purposes, but I do think it's useful. I think it's useful for your own situation. I think it's useful for managing your clients' finances. I think it's useful if you're going to be doing any kind of work on the financial side with your clients. If you're going to do RRSPs or leveraged investing, you really have to understand the tax advantages of those types of investments. Thank you very much. Enjoy your continued studies.